Hello and good morning. It is 10 o'clock on the 14th of July. My name is Jonathan Greenstein and welcome to today's webinar, FCA Cryptoasset Registration, What Firms Need to Know in 2022, presented by ComplyPort. It's important for me to tell you now that this webinar is being recorded and that the recording has started, and we'll be sharing this recording at the end of the session. The crypto asset industry brings innovation and new instruments to the global financial services market, and despite hitting some bumps in the road, it seems like it's here to stay. The question we are looking at today is, how will it be regulated? At present, crypto assets are only regulated in the UK for money laundering purposes, and the FCA does not have conduct or consumer protection powers over the sector yet. Whilst the FCA put in place a temporary permission regime, or TPR, for firms that were registered before the 10th of January 2020, allowing to trade whilst going through a registration, new firms need to register before conducting business. In their most recent business plan, the FCA stated that the developing and inputting of crypto policies is one of their key activities for 2022 to 2023. They assert that they are continuing to work closely with government and other parties through the Crypto Asset Task Force to design a UK approach to regulation that balances innovation and competition alongside the need for orderly markets and consumer protection. How will this affect firms now, and what does the future for the crypto asset industry, as well as the regulation of said industry, look like in years to come? This webinar will look at the crypto asset industry in its current state, the FCA's role as a regulator here, discuss the registration process crypto asset firms need to take with the FCA, and the future, and the ongoing requirements of being registered for money laundering purposes. Today's session will be delivered by two industry-leading experts, Richard Corbin, Director of Authorizations, and Martin Schofield, Director of Financial Crime and Forensics, both from ComplyPort. Prior to joining ComplyPort, Richard spent in excess of 20 years working for the FCA, including as a manager in the authorizations division, and leading, amongst others, the changing control and passporting teams. Before that, Richard was a manager in the FCA complaint scheme and also within the Regulatory Decisions Committee team, during which he held lead responsibility for managing the FCA's relationship with the Independent Complaints Commissioner. Martin brings over 21 years of financial crime prevention experience as both a MLRO and specialist consultant to his clients at ComplyPort. He has been engaged on and led numerous global and domestic projects, including the delivery of staff training in all aspects of financial crime prevention, such as fraud and money laundering prevention, as well as policy authoring, reviews, audits, and pre- and post-regulatory visit reviews and monitoring. In addition to this, Martin has also co-authored the Joint Money Laundering Steering Group guidance notes and acted as a lead investigator in countless investigations involving fraud and money laundering. At ComplyPort, we are specialists with regulatory, compliance, and financial crime consultants. Our team are experts in FCA authorizations and registrations, having successfully assisted in over 1,000 of these, day-to-day compliance, regulatory and financial crime support, and assisting firms in meeting the requirements of and implementing new regulations and laws. In addition to those services, ComplyPort also provides a RegTech solution to firms that supports them with compliance monitoring, the management of documentation, and the internal liaising required for sign-off of financial promotions, gift entertainment, etc., all in an order-driven environment. Now, before we begin promptly, I would like to cover off some brief housekeeping points. Either at the top or bottom of your screen, depending on how you have it configured, you will see a button called Q&A. If you have any questions, please ask them in there and we will get to them get through as many of them as we can towards the end of the session today. Please do not post questions in the chat function, as this will not be monitored. So just before we welcome our first presenter, we've got a couple of poll questions to ask of our audience to gauge who we have on here with us today. So what I'll do is I'll launch these initial 3 polls and then we'll jump into the presentation. So let's launch the first poll now. Should come up on your screens if you could please answer. The first poll is, are you planning to register with the FCA as a crypto asset provider? Yes, no, or not applicable. What we'll do is we'll give a few moments for people to answer before we end the poll, and then we'll launch the second and third one. A couple more moments. Let's end this poll now. Let's launch the second poll very quickly. So the second poll, you'll see it come up on your screen in a second. Are you already registered as a crypto asset provider with the FCA? Yes or no? Just wait for everyone to get their answers in. Give it a couple more moments. Fantastic, and we'll just close that off there and get the third one up very briefly. Here we go. Is the FCA doing a good job with the registration and ongoing of financial crime regulation of crypto asset firms? What do you think, yes or no? With this one, what I'll do is I'll share the results afterwards so we can see what everyone has said as well. It should be quite interesting. We'll give it a few more moments for people to get their answers in. Okay, so let's end this poll here. We'll share the results just so you can see. And it's almost even, but most people think that the FCA is not doing a good job, 56% compared to 44% who think that they are. So I'll stop sharing that quickly. And thank you to everyone who responded in these polls. Now, with that in mind, what I will do is I will invite my colleague, Richard Corbin, to start today's discussion. Thank you very much, Richard.
Thank you, Jonathan, and good morning, everybody. So my role in this session today is to give you an overview of the FCA's AML registration process for crypto asset firms. The intention being to hopefully sort of give you a better understanding of what the process looks like in terms of the information that the FCA will require from a firm seeking registration, some of the challenges that come up in the course of the registration assessment, and some feedback on the experience that we have been seeing and that other firms have been seeing in relation to the FCA's handling of these registrations to date. So with this first slide here, it's really just a scene setter. As Jonathan mentioned in the introduction, we've seen a temporary registration regime in the past that was put in place to manage the transition of existing businesses that needed to become registered for AML purposes. So they were the lucky ones to some extent. They were the ones who were able to get their businesses started and carry on business before the need to become FCA registered. But the situation has evolved and the situation has changed, and the position is now very binary. So bullet point 2 there, if you're wanting to carry on any of the activities that fall within Article 14 of the Money Laundering regulations, then you are going to need to be registered with the FCA before you start to conduct that business. Very briefly, in terms of the sorts of businesses that we are talking about, they are listed there in bullet 3. And as I've mentioned, the detail behind that sits within Article 14 of those money laundering regulations. So those of you that want to perhaps research in more detail exactly which firms are caught by these regulations will find that information there. And finally, on this slide, what is this all about then? So what's the purpose and what's the objective of having this registration? Well, as will become very clear as we go through the webinar, it's very much geared towards focusing on a firm's anti-money laundering and counter-terrorist financing procedures, and the aim is to ensure that businesses carrying on crypto asset work are able to identify or if necessary, stop money laundering through their firms. So next slide, please, Jonathan. So looking at the registration process itself, I can describe this pretty quickly and pretty easily here, because everything that you would need to provide to the FCA is captured within their Connect system. So if you find yourself needing to begin an application for registration to the FCA, you need to register on Connect, find your way through to the relevant process, and then have a look at the information that the FCA will require of you, and that is summarized here. So not surprisingly, the FCA will want some details about the firm and some contact details. But then there is an increasing level of challenge as you work your way through Connect. And I will give you a bit more insight now into things like the program of operations and what sits within the crypto asset supplement. So Johnny, next slide, please. The program of operations is relatively straightforward, I would say. In some respects, you could say that this is the FCA sort of setting you off with a bit of plain sailing to begin with, and essentially what it is wanting of you in the program of operations is to set out the scope and the nature of the crypto asset business that you plan to carry on. And one of the things it will be interested in is where you're going to be carrying it on from and what the sort of volume of business is that you're expecting to carry out. What you will see as we go through these is that there is a degree of overlap. There can be a sense that in certain instances the same information is being asked in more than one place, and you'd be absolutely right to perceive that there is some scope for duplication in this. Next slide, please, Johnny. So once you've covered off the program of operations, you then go into the crypto asset supplement, and this is where things start to get interesting in terms of the extent and the nature of the information that the FCA wants from you. One of the key things that it will require of you is a business plan, a detailed business plan. Within Connect, the FCA does actually provide some fairly helpful, albeit high-level commentary, which would help you to understand what exactly it is looking for from you. So that's quite a useful starting point. And what you would glean from reading that commentary is that the FCA is going to want to know all of the crypto activities that you're planning to carry out. It's going to want to have some detailed budgeting and forecast financial information from you. It's going to want to understand what your marketing plan is and how the activities as a whole are going to be managed on a day-to-day basis. Next slide, please, Johnny. As you work your way through the Connect system, you will also start to find that the FCA becomes quite interested, or in fact very interested indeed, in the various individuals who will be sitting within the firm. So this is going to include the beneficial owners of the firm, the managers, so the directors, and the MLRO, the Money Laundering Reporting Officer, who we will see is quite a key person, to say the least, within this application for registration. One other thing that we will come on to see as we look a little bit more closely at this is really the FCA is going to be very interested here in understanding the knowledge, the experience, and the fit and proper status of each of the individuals that are put forward in the firm here. Next slide, please, Jonathan. This will probably come as no surprise at all, but another key part of the crypto supplement in the application is going to be the provision of details from you regarding the firm's AML processes, and Martin is going to talk a bit more about this further on. So I'm not going to dwell too much on this, but what I will say is, again, the Connect system does provide some useful commentary as regards the information that the FCA is interested in, and that the interest and that the FCA is looking to hear about from you. There is a very big but here, though. You will not get away with simply trotting out information that is not sincere, if I can put it that way. So listing a number of processes or providing the information that you think the FCA wants to get from you is not going to cut it. You will find out further down the line that the processes that you are talking about here will be absolutely key to the question of how the FCA assesses your application. And this is really the stuff that you need to be living and breathing. So they're going to want to understand things like the periodic assessments and the controls that are going to be getting carried out, who the people within the firm who are going to be, who will be responsible for this, how you're going to monitor outsource functions, those sorts of things. That's by no means an exhaustive list, but it gives you a flavour, hopefully, of the sorts of things the FCA will want to know about, and there will be a very real expectation that you are sort of properly and fully prepared to do these things as and when you become registered. Next slide, please, Jonathan. So the next thing that I'm going to cover here, which takes us back to the individuals within the firm. So thinking about the individuals and beneficial owners that you have detailed in the registration process. For each of those, the FCA is going to want to make a fit and proper assessment of them. So what you will find in Connect is that when it comes down to answering questions, there are a lot of questions around the fit and proper status of individuals. So 7 pages of them. 4 of them relate to questions around potential criminal or civil proceedings. There's a page of questions on business and employment, prior business and employment, and then there's 2 pages on prior regulatory history. This is quite a challenging area. Normally in an FCA authorization process, which this isn't, this is a registration as opposed to authorization, you would have a Form A to complete, which is quite prescriptive, quite a lot of work, but actually, you know, for most of the for the most part, the signposting that's in the Form A is pretty good, it's pretty helpful. Here, there are some, as I put it here, some potential banana skins. So, you know, full disclosure of anything that you think ought to be told to the FCA is absolutely key. And the indications are that where that full disclosure is found not to have happened, then that will tend to have an adverse impact on the registration as a whole. Next slide, please, Jonathan. Okay, so so far so good. We've done a sort of lightning tour through the information that the FCA will require from you in support of a registration application. You'll get it over to the FCA, they will get to work on it, they will assess it, and they will give you an answer in due course as to whether they are prepared to grant registration or not. The or not aspect has been quite a common feature of registration so far. That's to say, there have been quite a high number of firms that have not been able to reach the threshold and have not been granted registration. So in the FCA's own words, what are the kinds of reasons that registration won't be granted? Well, the bullet points that are here are their words, not mine, and I think they are sort of very self-explanatory for the most part in terms of what the FCA is interested in and why it may turn around and say computer says no in your case because of issues that it has identified. In the authorization world, the FCA has an expectation that firms approaching it to get authorized are what they call ready, willing, and organized. So everything is absolutely in place and good to go. And to a large extent, that approach tends to hold here as well. The main issue that I think the FCA has fed back on so far as regards reasons for refusing registrations has tended to come down to a lack of AML knowledge within the key individuals that are going to operate within the firm. So people demonstrating, for example, limited understanding of Proceeds of Crime Act, joint money steering group, understanding those sorts of things. So that is absolutely an area for key focus. Next slide, please, Jonathan.
Richard, thank you very much. Before we continue on to the next slide, based on the bullet point on the slide, we actually have a couple more questions to ask of our audience. So what I'll do is I'll launch it very quickly here. I'll come up on your screen. Here it is. Are you confident that your financial crime policies and procedures will stand up to regulatory scrutiny? If you can let us know the answers, yes or no, please. And we'll give it a few moments. What we'll do is we'll share the results of this poll, just so you can see what other people are saying. And following this, we will have one final poll. Then there'll be no more of them from me today. So if you give me 2 seconds, we'll give it a couple more moments. Let's end the poll here now and share the results. So the vast majority say yes, they feel that their financial crime policy and procedures will stand to regulatory scrutiny, 85% of people, whereas 15% said no, they would not. So let's stop sharing that and launch the final poll. And this is really about MLROs. So how many years of experience does your MLRO have? 0 to 1 year, 2 to 3 years, 4 to 5, 5+, and I don't have an MLRO. See what we'll wait for a few more moments until the questions have been answered, and then we will jump back into the actual presentation. So give us 2 seconds, give a few more responses to come in. We'll end the poll, share the results, and then we'll carry on. So let's end the poll here now. Share the result. The majority of people say that the MLRO is very experienced and having 5 years or plus, whereas followed by that 2 to 3 years, and then a lot of people don't actually have an MLRO yet. So if it is something that you're looking to go through the application, it's something you would need to have in place as part of that. So let's stop sharing, and what I'll do is go to the next slide, as Richard had asked. And thank you very much, Richard. Back over to you.
Thanks, Jonathan. So just a couple more slides from me before I hand over to Martin. I mean, a summary here of what the experience for firms has been so far. As touched upon earlier, the refusal rate, or the rate at which firms are urged to walk away by withdrawing their registration application, is actually very high. We're seeing a lot of firms do not make the grade, and as a result do not get registered, having gone through the assessment process. There has been a sense that actually the way in which the FCA is approaching this is in fact more akin to a shadow authorization process. And what we mean here is, you know, as we've talked about, this is a registration process that is intended to be largely focused on the firm's AML processes. So that's one part of what would be looked at in a wider authorization application, where, you know, the FCA is looking all across the firm's proposed activities and looking in some depth at everything that the firm is planning to do. And actually what seems to have evolved here is you know, something fairly similar. It is quite difficult to distinguish the AML registration application from the full FCA authorization application. Timings have been an issue here. There's absolutely no doubt about that. The FCA is afforded a 3-month window once you have made your application to register, to make its assessment and issue its decision to you. But we have seen that these assessments are taking far longer than that. So 3 months, look at that as 60 working days in effect, and what we're seeing is that actually these assessments tend to go across hundreds of days rather than tens of days. That issue has itself caused some tensions within the industry. You know, we have heard about firms deciding to abandon registration applications and to go elsewhere, as in set up outside of the UK. And this issue has also caught the eye of the sorts of people that the FCA probably wouldn't want to be scrutinising them, so that there has been a suggestion that there is a lack of clarity in what the FCA is doing here at the moment, and the Treasury Select Committee has come out and said, you know, as far as it's concerned, the FCA is being far too slow in dealing with these applications. So that hopefully sort of gives you a bit of context, a bit of understanding as to the pain that firms are feeling as they try to go through this process. And then finally, after having heard all about this, and on the next slide, please, Jonathan, for those of you who might sort of want to go away from this and sort of look at some evidence of a real case, so something that has been happening in the context of these registration assessments, then look no further than the case of Giddy Plus. So there is a decision that has come out on that is in the public domain, because the FCA's view on Giddy Plus was referred up to the upper tribunal that issued a decision in February of this year. And what you'll see if you look at that is good evidence, I think, of the sorts of things that we've been talking about. So the firm's director was interviewed by the FCA, and the FCA says that it wasn't satisfied as to the adequacy of Giddy Plus's anti-money laundering systems and controls. And then it went on, as a result of its assessment of the individual and the interview that took place, it also formed the view that the director wasn't able to demonstrate that he had adequate knowledge and skills to have stewardship of the firm under the money laundering regulations. I think the quote at the bottom there is absolutely key. So Regulation 18 of the MLRs, it requires firms to take appropriate steps to identify and assess the risks of money laundering and terrorist financing to which its business is subject. And obviously here the FCA wasn't satisfied that the applicant was meeting the relevant threshold. So thank you for listening to me. That was my sort of run through the FCA AML registration process.
Thanks, Richard. That was incredibly detailed, and I'm sure our audience found it invaluable. Now I would like to welcome Martin to carry on today's presentation.
Thank you very much indeed, Jonathan, and good morning to everybody. The elephant in the room. I mean, listening to all of that very useful information from Richard, just thinking about some of the points and some of the things we're seeing. And as you can see from what's on the screen now, there's a number of kind of elephant in the room statements there and some observations, which, you know, for the process that the FCA are putting together and requiring firms to go through, there seems to be some kind of level of disconnect between the desired outcomes and what's actually happening in reality. So just to run through those very quickly, you know, there does seem to be this apparent disconnect between who is now the ex-Chancellor of the Exchequer and the regulator. So, you know, Rishi Sunak stood and said he wants the UK to be the tech hub of the world, and he welcomes and encourages all of the kind of crypto asset world. But yet, as Richard has already articulated, so few firms are actually getting through the FCA's doors. So on one hand, we have, you know, Treasury saying, yes, we want it to come in. On the other hand, we've got the regulator seeming to be rather reluctant to let people through into the authorized space. And obviously, that's, you know, that does raise some questions, especially as we're seeing authorizations being refused with no obvious reason at times, and not just from our point of view, but you know, from the wider market perspective. There's an awful lot of noise and frustration in the market that there are perfectly good applications being submitted, but with a minded to refuse coming back. Maybe that's an apparent you know, due to this apparent lack of consistency with the case managers. Maybe they have different approaches. There does seem to be this kind of arbitrary approach from caseworkers at the FCA. It depends very much on who you get as to what outcome you get. It is making firms and consultancies alike very frustrated. And, you know, possibly it has something to do with the number of vacancies within the authorizations team. I mean, it wasn't that long ago they were advertising, you know, to fill 100 spaces roughly. So maybe it's a matter of the FCA not being fully manned to be able to deal with these issues and these applications, not being able to rely on a consistent approach because they've got people kind of jumping in and jumping out. We don't know. Obviously, we don't know how that is actually working at the FCA's offices, but it does seem to be creating this level of frustration and a demonstration of an inconsistent approach to not only the authorization process, but also to what the government is wanting and what the FCA are doing. Worth mentioning, though, obviously, as Richard has said, there isn't a very small number of firms that are actually getting through the authorizations process. And it's important to remember that the FCA's role in this is to regulate the industry, and then it authorizes firms to actually operate within that industry. So if the FCA doesn't have the confidence for any reason whatsoever that a firm could operate successfully and competently within the industry that it regulates, and therefore causes that regulated industry to come into any form of jeopardy, then it's going to either reject or eject. I mean, even existing firms can have their licenses and their registrations and authorizations revoked if the FCA believe that the firm has brought the the potential damage to the economic sector into question. So I think it's important that we balance this with a view from, on the FCA's behalf almost, that it's possibly rejecting because it is afraid that firms will not cause harm to the regulated sector because they don't have sufficient controls, sufficient understanding, or at least are able to demonstrate that, as the Giddy Plus example that Richard went through explains in more detail. The other kind of question that has to be asked, though, is does the FCA know enough about this particular sector to be able to, to manage the application process here? Does it know enough about how to authorize and regulate the sector, given that it is so new? Does it have the internal knowledge? Again, something we don't know. It's a rhetorical question. But the FCA must have that level of confidence. And I think that's where, say, the Giddy Plus example comes in, and it shows that it's not just about having a set of documents put together. And I think that's one of the really important matters to address. I mean, interestingly, from that poll that we saw there, 85% of the respondents said that they believe their policy would withstand regulatory scrutiny. Yeah, I'm sure that is the case. I don't dispute that at all, but I would probably think that some of the firms that have applied for authorization and been rejected for no apparent reason thought the same. So, we can think one thing, we can think our policies and procedures are robust and would withstand regulatory scrutiny, but quite often that's not the case. And the documents themselves, in and of themselves, may withstand regulatory scrutiny, but it could be it's when the owners of those documents, or the people that are required to live and breathe and act out the requirements of those documents, when those people are asked to explain the contents, are asked to explain what they actually mean and what they do, maybe it's at that point that the FCA loses confidence. The fact that the people that are responsible for discharging the money laundering prevention requirements and complying with the money laundering regulations, maybe it's that area that causes the issue. And that comes back to that ready, willing and organized piece that Richard spoke about as well. The ability to be able to demonstrate beyond any doubt to the regulator that you are capable of doing your job and discharging your responsibilities. Bearing in mind that point that I said, which is really important, that the FCA is almost giving you authority to manage affairs on its behalf. It regulates the entire financial sector, and it will only allow people into that sector if it believes that they are not going to bring jeopardy. So if the policies and procedures in their document form are robust, but the person owning them or being interviewed by the FCA cannot speak to those policies in a convincing way to actually know what they mean and what they require, then that can be where that minded to refuse notice comes out. And it's the same as the business plan. I mean, from that perspective, you wouldn't expect someone to own a business and not understand what their business does, who their target market is, what their competitors look like, where their competitors are based, and what kind of market share they expect to be able to get. Just basic principles of a business plan. So if you've got those basic principles of a business plan that require you to understand it in that level of depth, then you are also required by the FCA to be able to speak not only to your business plan, but also to the way that your business will run and the risks that it faces from a financial crime perspective. And no doubt there is an element of learning involved there as well. The FCA will be listening to all the interviews, reading all the policies and procedures, and they will be taking points from that and seeing what they assess as being as good practice and what they assess as being bad practice, and then making determinations from there as to where the benchmark and the threshold sits. I mean, that's the kind of, that's the ergonomic way that the regulator has always worked in all of its guises over the years. Those with what appear to be the best and the most efficient controls will set the highest standard for everyone else to follow. So certainly, the FCA does seem to be rather reluctant to mass authorize or allow registration, if you like, for crypto firms. But maybe their caution is justified, and maybe it's preemptive. We've seen a slump in the crypto market recently, and maybe that sits somewhere behind their decision not to overly commit to the market. Maybe it's trying to protect the consumer at large and thinking it doesn't want to overcommit to this market if the market isn't going to survive. I mean, at the opening of the webinar, Jonathan, quite rightly said that it does appear that crypto is here to stay. But is the FCA's view, well, until it's proven that it's going to stay, we're going to be a bit more reluctant in the market. We don't know, but there may be that element there that is causing that kind of caution and hesitation on their part. Richard's already touched on this as well, for sure. You know, is the FCA's actions in kind of being reluctant to allow firms in, is that going to push firms out into the wider European market to become registered? Quite possibly it will. But then, you know, the EU has this new markets in crypto assets law coming in, set to come in 2023, which actually widens the scope even further. So we're not just talking about AML registration and being able to talk to, you know, AML risk anymore. The new MiCA law is going to require firms to be able to demonstrate how they protect against market abuse and market manipulation, and the environmental impact of their assets. So it's going to, on one hand, you know, the FCA's actions may push firms into the wider European market, but on the other hand, if they go there, they're going to have even more questions to answer. So it may kind of cause a rebuttal back into the UK. Who knows? We'll have to watch the space for that. And obviously we have to watch to see if the MiCA law does actually come in next year as is planned. It may get pushed back yet. We don't know, but certainly it's planned to come in for next year. So there may be some implications there. Having said that, even if the MiCA law does come in next year, there is, of course, nothing to say that the FCA won't follow its practices and start looking to firms to explain and guard against their market abuse and market manipulation, environmental impact, etc., in this country. So the FCA may simply follow suit from the MiCA law rather than lose business to it. It may just replicate the same requirements. So again, things to watch for, things to watch in this space, and obviously, you know, we'll keep a track of that, and we'll post regular updates for things like that on our website if anyone is willing to and wanting to follow to keep up to date. Okay, so next slide, please. So we've talking about this quite a lot. The AML requirements for crypto registration. So what are they? Broadly speaking, they're the same as they are for any other firm. They're the things that the FCA really want to see and believe that a firm has in place. Things that exist, things that are lived, understood, documented, and people can speak about and understand into great detail and at great length. You know, so senior management responsibility, yep, they want to know who's responsible. They want to be able to hold someone accountable if something goes wrong, for sure. But they want to be able to get the comfort feel that someone is in charge, someone knows what is going on, and someone is steering that ship competently, not steering it in a way that, well, this is the way we think you might want it to be, and so this is what we'll do, or we heard from the guy next door that this is what they do, so we're replicating the same thing. You know, they actually want to believe that you know what it is that you're doing, that you have this really willing and organized approach so that you can control how your firm is running. To have policies and procedures, again, we've touched on these a couple of times already. Again, 85% of you say yours are likely to withstand regulatory scrutiny, which is great, and I hope that they do. But certainly from that perspective, having clearly documented policies and procedures and being able to explain them at any part of them is absolutely vital. Having an off-the-shelf policy is never going to work. I mean, generally speaking, there were some statistics issued recently that showed the final notices and enforcement actions from the FCA from 2020 to date. Actually, 100% of those final notices somewhere applied a criticism to policies and procedures. So 100% of enforcement actions since 2020 have some level of degree of criticism towards a firm's policies and procedures. So, I would just, as a friendly warning to those 85% of you that said yours are likely to withstand regulatory scrutiny, I would urge you just to have another look at them and just make sure that that is actually the case. If enforcement actions since 2020 have 100% applicability to lacking policies and procedures. So certainly those are going to be key. And a firm's risk assessment of itself is absolutely vital. That self-analysis, that self-criticism to be able to reflect into your own firm and say, this is what we do, and this is what the risk of what we do is. Every firm carries risks of varying natures, legal risks, operational risks, financial risks, legal risks for being used for money laundering purposes, legal risks for being prosecuted, regulatory risks for not having appropriate controls in place. Every firm has a number of different risks, and what the FCA want to see is that you've analysed yourself to the point that you understand where your risks and exposures exist, and that you've either accept those risks, you mitigate and control those risks, or you transfer those risks somewhere else and you give someone else the responsibility for them. But that's what they want to see, is that you know where those risks are and that you own them and control them. The senior management understanding of the business model, the risks of the business, and how to control and mitigate them is always going to be a key part, and in my experience will always be something that the FCA will take interest in, whether it be remotely or whether it be in an interview. They will always want to see that you've got an understanding of your risks. And one of the things they don't want to see, in all honesty, from the first-hand experience, is when they ask questions of policies or procedures and they say, can you please explain how, for example, you undertake transaction monitoring? What they don't want is for you to send back your transaction monitoring guide. If they ask, please explain, they don't want you to send something that requires them to read. They can read, and if they wanted to read, they would ask for the document, but they don't. They want to hear from you how it works. So again, be mindful of that when the FCA ask a question, an open question that starts with, can you please explain? They don't necessarily just mean, can you please send us a document for us to read for ourselves? Because again, they will look at that and think, is that just an off-the-shelf document? Is it something that's been created for the purposes of providing us with information, but it's not something that you can actually answer to? And if this is being dealt with remotely, just through an email request from the FCA, I have to say I would agree with that view. If I asked for someone to explain their view on something, and what they did is provide me with a document, my first question would be, why? Why did you give me a document that I can read for myself rather than do what I asked you to do, which was explain to me what your view of this is? Because if you can't explain it, when asked to do so by the regulator, my immediate question, if I was them, would be, is it because you don't understand it? And then we come back to this whole senior management responsibility piece and this being ready, willing, and organized to operate a business. So if the questions are there to explain, then we really must do so. Having appropriate and risk-based customer due diligence, so understanding where your risks exist, understanding how your customer risks exist, understanding where all of your other kind of, your transactional risks, your geographical risks, etc., where they all exist, and how you undertake due diligence to mitigate against them. How you actually undertake your due diligence process, how you identify who your higher risk customers are. Have you identified who your unacceptable risk customers will be? What constitutes a standard risk for you, and what constitutes a simplified risk? And how do you actually manage those, and what due diligence do you undertake on that basis? And then from there, how do you monitor that risk on an ongoing basis? So, there's a distinction, a clear distinction between transaction monitoring and compliance monitoring, and we need to make sure that we have those properly documented and properly understood. So, the transaction monitoring is looking at transactions that you would want ordinarily to see because you think under the Proceeds of Crime Act, you would have a reporting obligation if such a situation arose. So essentially what you're looking at for transaction monitoring is using the computer to identify for you something which your money laundering reporting officer would want to see, because that would create a suspicion, or at least reasonable grounds to suspect that money laundering may be occurring. So, for example, a very, very simple and easy example, 20 applications for accounts from the same residential address. So something very, very simple, but something that you would want to see, well, hang on, this wouldn't make sense. The vast majority of the whole suspicious activity reporting regime rests on the principles and the foundations of the does it make sense test. So for the transaction monitoring side of things, what you're looking for is being able to demonstrate to the FCA that you have appropriate transaction monitoring reporting in place to be able to identify something that wouldn't pass the does it make sense test. And if it wouldn't pass the does it make sense test, there's a very high possibility that you've then got a reporting obligation to the National Crime Agency. So that's the transaction monitoring side. Then the compliance monitoring side is obviously the part that monitors this entire program. What is your compliance monitoring program looking like? So you've identified your senior management that will be responsible. You've got your policies and procedures. You've got your risk assessment. You've got your due diligence requirements clearly documented. You've got your training for your staff and for your management. How often is that training going to be delivered? What form will it take? How will people be assessed for their competency having taken that training? What's the record keeping requirements for your entire financial crime program? All of that has to be documented, and once documented, it should sit in your compliance monitoring program. So how you're actually going to continually monitor and evaluate that to make sure that it remains fit for purpose, fit to your business model, and fit to withstand regulatory scrutiny. More importantly, how it still is fit to protect the consumer from any harm and damage, because that's where the regulator is very, very keen and very focused to make sure that any firm within the financial sector doesn't cause harm to the participants of that sector. So you have to continually monitor your compliance with your own procedures. Something I've seen firsthand on a number of occasions is the regulator getting slightly more agitated when you don't comply with your own policies compared to maybe when you don't comply with one of their rules or even part of the regulations. And to an extent, quite rightly so. If you can't comply with the policies that you wrote for yourself, for you to comply with, then what chance have you got of complying with anything that somebody else has written? And that's the view they take. So the compliance monitoring program allows you to keep track of how you're complying with your policy, when you've taken exception to policy, who authorized the exception to that policy, how far up the food chain in the company did that authorization have to go. So do the people that set the policy actually get to authorize exceptions and variations to that policy? And if not, why not? Why is that not being escalated to the people that write the policy and own the policy and approve the policy? So, for example, a very simple question would be, if the board authorize a policy, if they endorse the policy, then should the board not see where exceptions to that policy occur? And if they don't see it, then how are they really owning the policy? Where's that senior management responsibility? If they do see exceptions, do they see them in advance, or are they always retrospective? And if they are retrospective, what kind of reporting frequency do they get so that they can actually make sure that they're on top of everything that is actually being varied from the policy? Or is it something that they get once a year, in which case it will be far too late for them to do anything about if they didn't agree with the variation? Okay, we can go to the next slide, please, Jonathan. So some of the key areas for risk assessment, which touched on a few there already. The product and service. So actually being able to understand and explain to someone what is cryptocurrency, what is the line of business. This again links into the business plan side. So being able to explain what it is that you do, why you do it, who your target market would be, why they are your target market, how you can actually service them, what would you be providing to them, and why do they need it? And also from the product side, what is the risk of that product? How does that product vary? How could the risks manifest themselves? And how would you control them? And at what point can you stop? Do you stop controlling them? And does the risk become unacceptable? So client and customer, again, who are your clients? Who are your customers going to be? And what risks do they present to you? Every single firm, whether they believe it or not, has a high risk, a medium risk, and a low risk customer. Some firms, and a lot of them I speak to, say, oh, we don't have high-risk customers. You do. Every firm has a customer that presents a higher level of risk than all other customers. It may be that your highest risk customer doesn't even meet the lowest risk customer classification of another firm. That's perfectly fine. Don't try and hide high-risk customers from the FCA either, because the FCA also know that every firm has high-risk customers. And if you tell them that you don't have any, you'll immediately put yourself on their radar, because they'll assume that you're not classifying your customers correctly, because every firm does have them. Understanding them and deciding whether you want to control that risk and how you're going to control that risk, or whether you're going to eject that risk and off-board or not on board that customer is the key to it, but certainly not hiding that you have them. Your delivery and distribution risks. So how do you actually undertake business with people? How do you contact your customers? Where do you usually meet them? Do you ever meet your customers face to face? I mean, I know that's quite a thing of the past, really, now, face-to-face meetings with customers. But for a lot of firms, they do still meet their customers on a face-to-face basis. And so, being able to demonstrate how you deliver your product or service to your customer is a key requirement for the FCA. Obviously, the more remote the delivery, so if it's all via internet, via online application, etc., and you wouldn't know who your customer was if they stood up in your soup, then you've got an increased risk, because straight away you have the risk of impersonation fraud, because you don't really know who your customer is, you just know some information that's been provided to you. So the level of due diligence that you undertake should reflect the level of risk associated with your delivery and distribution channel. So the more remote, the higher the amount of due diligence you should be collecting, so that you can demonstrate that you undertake a higher level of scrutiny on those customers who you have less contact with, because the ones that you have less with present a higher risk. So the transaction risk, so looking at sort of what the level of transaction is this normal for the kind of customer base that you expected to undertake business with? Is it normal for your customer? So is the person that said, this is what I'd like to do, this is the amount I'd usually like to buy in crypto, for example, this is the amount of Bitcoin I'd usually be trading in, all that kind of stuff. When they move outside of that sphere, when they start acting in a way that is outside of the profile that you have built for them based on what they told you at outset, that's when you need to be acting as well. So I think it's probably fair to say that the vast number of reports that are made to the National Crime Agency for potential money laundering all would fit the criteria of the fact that the activity of the customer is not commensurate with the profile that the firm had on them. They're all acting out of character. So that's where you need to assess the kind of transaction level in the first place. Is this the kind of business that we said we would do in our business plan? Is this what we expect of our customers? And then if it is, then you just continually monitor it as part of your risk assessment process to be able to say, is this still in line with our business plan? Is this still in line with what the customer told us they'd be doing? So you have that kind of transaction monitoring piece kicking in again there, and then you'd have the formal sort of like risk review, if you like, so that based on the risk status of high, medium, or low, being, for example, 12 months, 18 months, 24 months, whatever the firm decides they will do as the formal risk review of all of these processes. And then finally, the geographical risk. So where is the customer? Where are you? Are you in a country that is deemed to be high risk for money laundering purposes? Is your country high on the list of for Transparency International? So you've got a high exposure to bribery and corruption. Is that where your customer is? Are there sanctions? Are there sanctions in your country against people in your country? Are you a high target for sanctions? All of those kind of risk assessments for the country need to be taken into account. And in theory, all of those areas there, all of those 5 areas, you only need one of them to represent a high risk factor, and your customer risk should be high. So, even if you've got a low risk customer with a low risk product, good delivery, good well-controlled delivery mechanism, transactions are all within expected parameters, but the geographical risk is high, then that should taint the rest of the relationship. One rotten apple will contaminate the whole barrel. The whole thing should be high if you have any part of that is high. Doesn't mean to say it's not controllable, you can't mitigate against it, but it should represent a high risk relationship. Okay. And then Jonathan, back over to you. Thank you.
Thanks, Martin. Equally as informative as Richard's session. So this now concludes the formal presentation section of the webinar. And I'm going to open up to our audience to see if they have any questions for our panelists. And I've seen quite a few of them have come in. So what I'll do is I'll ask them out, and we'll have either Richard or Martin jump in, whoever is most appropriate to answer it. So the first question is, can banks issue stable coins under the proposed stablecoin regulations?
I'll take that one, Jonathan. So I think the situation here is still slightly fluid at the moment, because we are awaiting some delayed legislation around the stablecoin piece. What we do know is that there will be an expectation that stable coins, where used as as money, they should meet equivalent standards as those provided by more conventional bank money, otherwise known as bank deposits. So the answer there is that, you know, it looks as if, yes, they will be able to issue those in that way. Obviously, there will be a question as to whether ultimately the banks themselves choose to do that.
Thanks, Richard. Next question. What is the average time you are seeing from application submissions to FCA authorization/registration, and what are the best ways to reduce it?
Yeah, I mean, that was a point that was covered off to some extent, Jonathan, in the earlier presentation. I mean, the short answer to that question is it's not a quick process. It should be 3 months, but we are seeing that typically these things are taking hundreds of days for the assessment to be completed. Best ways to help yourself in terms of sort of wanting to get through the process as quickly as possible is really just to make sure that the quality and the detail of the application is right. Typically, the thing that will most delay an application for registration is either unclear information, so the FCA sits down, engages with it, reads it and thinks, don't really understand this fully, haven't got enough information, or it's presented in such a way that is slightly confusing. That is obviously then going to prompt the FCA to turn around and come back to the applicant to ask a, potentially quite a long list of questions, and that sort of stop start in the process is obviously one of the things that delays it. So as far as possible, you're wanting to put something under their nose that has them looking at it and saying, great, this firm gets it, they're giving us the detail that we need to know, we understand it, we like it, let's go with it.
Thanks, Richard. So next question, we've got time for a few more. We'll try to cover off as many as we can. Which is the latest AML guidance that firms need to refer to in putting together an AML risk framework for a crypto firm?
That would be me then, I think. Thank you very much. Various pieces of guidance. Obviously, you've got the 2017 money laundering regulations as amended and continue to be amended by the 19 and the 21 updates to it, for example. But then you've got part 1, section 22 of part 2 of the joint money laundering steering group guidance notes. So obviously part 1 being the general guidance and part 2 being the sectoral guidance. So section 22 is for crypto, so you can use there. You've got the FCA financial crime guide for firms, so that there's guidance that can be used in that. Various other pieces of guidance, the Financial Action Task Force VASP guidance will be useful. Also the Financial Action Task Force issued updated guidance for risk-based approach to virtual assets and virtual asset service providers. That was 2021, so that can be used. And then there's some other various pieces of FCA guidance that can be brought in. There was the Dear CEO letter from 11th of June 2018, that was around crypto. Policy Statement 1922, guidance on crypto assets, which was the feedback and the final guidance to the consultation paper. So various pieces of guidance that are out there, quite a large amount actually, when adding all that up, quite a large amount of guidance, probably more guidance on crypto than there is on anything else.
Thanks, Martin. Next question, the crypto asset registration requirement throws how wide a net? Could AR advising or arranging activities qualify?
As I understand the question, Jonathan, my answer to that would be no. So the question of arranging and advising, and in particular on investments, is a different strand. So that is going to be the mainstream authorization process that I made reference to earlier. So what we're talking about here today is simply the AML registration for crypto assets businesses, and those are the businesses that are summarized on the earlier slide.
And I think as a follow-up question to that is what activities can fall under this registration? So for instance, is managed accounts with crypto assets included?
There are a number of discrete or specific activities that are captured for this purpose. I think probably the best way to bottom out the answer to that, Jonathan, is for firms to engage directly with the information that the FCA puts out on this. So, you know, if you are starting to think about putting in a crypto registration, a very good place to start is going to be looking at the relevant section of the FCA website, and what you'll see on there is that they do detail the specific activities that are caught under this registration process.
I know we're coming up almost to 11 o'clock here, but we've got 2 more questions. I'm wondering if we can cover them off really quickly. The first one here is, if your company only accepts crypto as a payment method for goods, or if the GBP that you accept was from crypto after conversion, do you need to register?
My answer to that would be no. So again, the types of firms and the relevant activities, you know, people are able to go away and to sort of look at the details that are covered there, but they will be organisations sort of within the chain that would need to exist there, that would need to be registered. But if you are sort of merely the recipient of a payment, then no.
And final question here. Where there is a new customer-facing web application required as part of a proposed business, how functional does the FCA expect it to be before applying for regulation? How do you resolve the chicken and egg challenge of building and engaging with solution providers before achieving registration?
Good question. I think part of the answer, well, there is a clue to the answer there in the Connect system, because one of the questions that the FCA asks is whether you have a website or a web presence, and if the answer to that is no, it then goes on to ask, if you're going to have one, when do you expect that to go live? So okay, it's not exactly what's being asked here, but as I say, it's a bit of a clue to my mind that the FCA does accept the reality of the situation, that when you make a registration application, you may not have absolutely everything sort of nailed down because of logistical reasons. Having said that, the question that then arises, okay, if you're approaching the FCA and saying, okay, this isn't functional at the moment, but we have plans for it to become so, the key point then is going to be the type of detail that you are then providing. I mean, if you are saying to the FCA, yeah, we're going to have this web application further down the line, haven't really thought too much beyond that, then that is not going to fly. You are going to need to be able to demonstrate that you have given quite a lot of thought to this, and probably that you have already been out and spoken to potential solution providers. You're going to be able to say, okay, it's not functional yet, but I can give you a very good idea of what it's going to do, what it's going to look like, how it's going to get launched, and what the various controls that will be in place in relation to its operation that will prevent any problems occurring.
Thanks, Richard. So that's all the questions we've had. So I'd like to let everyone on this webinar know that CompliantPort can assist firms with their crypto asset registrations to the FCA, as well as provide advice, support, and guidance on financial crime regulation, policies, and processes. Now, this is actually for people on the webinar today, as well as those who'll be watching the recording. We are offering free consultancy meetings for those who are watching live and again on the recording, to discuss crypto asset registrations and or financial crime policies and processes. If you want to book one of these meetings, please email me. My details are on screen now, with some preferred dates and times for the conversation. Please can you refer when you email me that you are on the recording, so we can get this booked in for free for you. I'd also like to let today's audience know of our next upcoming webinar. On the 7th of September, we'll be hosting a webinar on the annual financial crime reporting obligations for Rep Crim, and how this will affect all the new firms that fall within scope. We'll be sending out a link to sign up for this webinar when the recording of today's session is published. I'd like to thank all the attendees on today's webinar for joining us for this really interesting discussion. As mentioned at the very outset of the webinar today, this webinar has been recorded and we're putting it online soon. Please follow CompliantPort on LinkedIn to see when it'll become available to watch. To Richard and Martin, thank you very much for your time this morning. And to everyone else, thank you very much and have a very good day.